Hello and welcome to Morningstar. Here with me today is Morningstar's equity analyst Matthew Donen to talk about the building materials sector. Welcome, Matthew. First, I would like to discuss with you some industry trends. We see higher energy costs, and in Europe we also see volume declines. So that means adverse conditions. How do the companies deal with those?
Well, price increases has been the biggest lever that the companies have used. In 2022, price increases of between 10 and 20% across different building materials allowed many companies in the sector to deliver double-digit revenue growth in 2022. What many companies have also been doing is they've shifted their product mix away from highly energy intensive cement production towards other building materials that are also widely used in more defensive construction activities such as repair and maintenance.
There are also positive developments, especially in the United States. What can you tell us about that?
Yes, that's correct. So the low value to weight ratio of building materials lends itself to highly regional markets. As you correctly mentioned, the US has a superior outlook to other regions, and that's largely due to recently signed legislative acts that were signed within the past year or two, which will support construction activity for both infrastructure and commercial construction. So you've got the 1.2 trillion Infrastructure and Jobs Act. Of that 1.2 trillion, 110 billion is going towards the building of roads and bridges and other critical infrastructure. And many of those projects we're expecting to see come online from currently now in 2023 up to 2025. You've also got the $250 billion CHIPS Act, which is encouraging companies to bring back their manufacturing activities towards the US. Subsequent to the act, many of the large semiconductor manufacturers, the likes of Intel and Samsung have already invested billions of investments to construct new semiconductor plants in the region. And then lastly, you've got the Inflation Reduction Act, which is encouraging electric vehicle manufacturers to have a large chunk of their supply chain in the US. And here we're seeing Toyota, for example, has already announced that it will be constructing a battery plant in the US. And we expect many more companies to follow suit.
To the background of those developments, one company is your top pick within this sector, and that is the company CRH. Why does CRH stand out?
Yes, so CRH is the most defensive of our European construction materials sector and our coverage. And the company will better withstand an economic downturn than some of its European concentrated peers. For example, as the largest road builder in North America, CRH is very well positioned for an acceleration in infrastructure spending in the US, underpinned by the 1.2 trillion Infrastructure Investment and Jobs Act. The company's also got a very secure balance sheet, and it's using that balance sheet and its superior outlook to reward investors with highly favorable and attractive capital return, both through dividends and a recently announced $3 billion share buyback. And lastly, I think it's also important to mention that CRH has the best ESG risk rating score across the construction material sector. And that's because only 15% of its revenue is generated through the construction of highly energy intensive and CO2 emitting cement production. The company is more widely exposed to aggregates, which is used to perform infrastructure construction, which also tends to be more resilient across the economic cycle and less dependent to certain macroeconomic indicators such as interest rates.
Now, this sector has been undervalued for some time, but recently investors seem to have rediscovered the sector again. So not all stocks are undervalued anymore. From a valuation perspective, which are the most attractive stocks at the moment, apart from CRH, of course?
Yes, you're correct in that. And Heidelberg Cement is actually still trading in undervalued territory. unlike some of its European concentrated peers like CRH or Holcim, the company remains heavily concentrated towards cement manufacturing. And we think many investors are unable to invest in the business due to ESG reasons rather than the underlying fundamentals of the business. So we still see some upside towards Heidelberg Cement.
Okay, Matthew, thank you very much for your insights in the building materials sector. For Morningstar, I'm Robert van den Oever. Thank you for watching.